why banks are quietly moving trillions to blockchain. The DTCC processed $3 quadrillion in 2023. Now it's running live tokenized trades with BlackRock, JPMorgan, and Goldman Sachs, ahead of an October production launch. That's not a pilot program. This is production infrastructure being installed while the old system still settles trades. The largest securities depository in the world is laying new track beside the old one. And if you're trying to separate signal from noise, this is the shift that actually matters. The signal gap. The gap between what the market is watching and what is actually getting built has never been wider. Right now, the public conversation fixates on price movements, ETF flows, and red candles. That's understandable because price is visible and immediate and it carries emotional weight. But the infrastructure underneath those prices is getting rebuilt in real time, and almost nobody is watching the construction. Think about the Transcontinental Railroad in the 1860s. The real investment thesis never revolved around the price of steel rails or the cost of locomotives. It revolved around the volume of freight that would eventually move across the network, and the economic transformation that came from connecting regions that had never been linked before. The same logic applies today. The value is not in the price of the ledger technology itself. The value is in the volume of assets that will eventually settle across it, and the economic transformation that comes from connecting financial markets that currently operate in separate silos. The DTCC reported that it processed securities transactions valued at $3 quadrillion in 2023, and its depository trust company subsidiary sits at the center of U.S. capital markets, handling trade reporting, central counterparty clearing, and depository services for equities, bonds, and other instruments. When a system operates at this scale, even a tiny delay in settlement creates systemic risk that ripples through every bank, fund, and trading desk in the world. The reason these institutions are moving so carefully is that they cannot afford to get this wrong. A failed settlement at this scale doesn't just cost money, it threatens the stability of the entire financial system. So the real question is not whether a token will go up or down next week, but what kind of infrastructure can handle settlement at this scale without creating new risks. Part 1. The broken plumbing. To understand why institutions are rebuilding the system, you have to understand how the current one actually works. The Bank for International Settlements, which is often called the central bank of central banks, describes the current monetary system as a collection of separate databases maintained by banks and other intermediaries. Each institution is responsible for tracking ownership and transfers in its own domain, and these databases communicate with one another via third-party messaging systems rather than shared ledgers. This architecture can work, but it introduces friction, reconciliation overhead, and delays because messages must be matched, instructions must be reconciled, and settlements must move through multiple layers of custody and payment systems. The messaging infrastructure that connects these separate databases originated in an era when batch processing was the only option, and it still operates with cutoff times that prevent true 24-hour settlement. Settlement cycles, such as T+2 or T+1, exist partly because of the time required to move securities and cash through custodial chains, clearinghouses, and payment networks, and to ensure that all parties' books and records are aligned. Although these cycles have been shortened over the decades, they still involve a combination of batch processing, cutoff times, and intraday credit exposures that create settlement risk. When you buy a share of Apple stock, your broker doesn't actually hold the share. It sits in a chain of custodians, depositories, and clearinghouses, and each link in that chain adds a layer of delay and a point of potential failure. BIS argues that tokenization's major leap is that tokens are not just digital representations of claims, but can incorporate the rules and logic governing transfers, enabling programmable conditions for settlement, and creating a single venue where money and other tokenized objects can integrate seamlessly. In the current fragmented system, conditional payments and complex multi-asset transactions often require bespoke legal agreements, manual intervention, or layered processes. In a tokenized environment, they can be encoded directly into the assets and executed automatically when predetermined conditions are met. But achieving this requires rethinking the underlying infrastructure rather than simply bolting on interface improvements, because the fragmentation and reliance on messaging are baked into the architecture of today's financial system. Part 2. The Collateral Trap. But settlement speed isn't even the biggest pain point. The real friction is collateral, and it has been the Achilles heel of institutional finance for decades. Collateral management is where banks and other institutions pledge securities as collateral for exposures such as derivatives, repos, and credit lines. HQLA with an X, which is a technology provider focused on collateral mobility, describes long-standing pain points in tri-party collateral arrangements where multiple tri-party agents and custodians are involved in holding and moving pledged securities. In traditional models, moving collateral between tri-party agents or across custodians often requires cross-custodian settlements, meaning securities must be delivered out of a bank's home custodian account to another institution, generating settlement risk, operational complexity, and costs. HQLA, with an X, designed a new operating model using its DLT-based platform to transfer securities collateral to or between multiple tri-party agents, without triggering these cross-custodian settlements. The concept involves using a shared ledger, which is HQLA with an X's books and records digital collateral registry, built on R3's Corda network, to record ownership transfers of securities, while the underlying securities remain in the custody location of the participating agents and custodians. When collateral needs to be exchanged between participants, ownership is swapped on the registry through delivery versus delivery transactions, enabling instant and simultaneous transfers without moving the securities through the traditional custody chain. This DLT-based approach can increase the speed and precision of collateral management activities, lower operating costs and risks, and enable longer intraday settlement windows because banks can instruct transfers directly between tri-party agents on the shared ledger. The digital collateral registry becomes a golden source record for securities ownership at the ISIN level, allowing instantaneous atomic gross settlement and reducing the scope for trade fails. HQLA, with an X, emphasizes that the industry has been trying to solve tri-party interoperability for over 20 years, and that its feasibility study confirmed its platform as a scalable solution for collateral mobility across tri-party agents and custodians. But the platform is limited to use cases involving exclusively non-cash collateral that can be settled, delivery versus delivery. And it doesn't currently offer atomic settlement of traditional repo transactions or derivative collateral transactions involving a cash leg because it doesn't integrate into DLT-based payment instrument settlement systems. This highlights both the power and the current limits of the HQLA platform's books and records approach, and it sets the stage for initiatives like JPMorgan's Kinexys that seek to bring cash tokens into the mix. Part 3. The production pivot, which is exactly why 2026 is different. The experiments stopped and the live systems started. In May 2026, the DTCC advanced its tokenization service with 50-plus firms, targeting initial tokenized security trades in July and a full production launch in October 2026. By August 2026, the DTCC had completed live tokenized settlement runs with BlackRock, JPMorgan, and Goldman Sachs ahead of that October launch. This is not a controlled pilot. This is the largest securities depository in the world, moving toward production blockchain settlement with the biggest asset managers on the planet. Euroclear is running a parallel track. Euroclear's DFMI, which stands for Digital Financial Market Infrastructure, has already settled notes from the World Bank, France, and Doha Bank. The ECB cleared digital bonds as eligible Eurosystem collateral for March 2026, and Euroclear's Project Pythagoras is targeting a €300 billion figure to move France's commercial paper market on ledger by late 2026. That's not a small test. It's a sovereign debt market being restructured on distributed ledger technology. JPMorgan rebranded its Kinexys platform from Onyx in late 2024, and the platform has processed more than $300 billion of intraday repo transactions since its establishment in 2020. The tokenized collateral network uses tokenized ownership interests in money market fund shares as collateral for the first time, enhancing collateral mobility by enabling rapid repledging of these tokenized shares without moving the underlying fund assets. In April 2026, JPMorgan highlighted Kinexys milestones, including JPM Coin launching on Base and the appointment of new global leader Ole Harris. By June 2026, JPMorgan had added 5 Asia-Pacific currencies to its Kinexys blockchain platform, allowing institutional clients to settle payments and foreign exchange around the clock. BlackRock's position is equally concrete. Larry Fink's 2026 chairman's letter described tokenization as a way to update the plumbing of the financial system. And BlackRock reports nearly $150 billion in assets under management connected to digital assets, including the world's largest tokenized treasury fund, tens of billions of dollars of stablecoin reserves, and around $80 billion of digital asset exchange-traded products. That tokenized treasury fund is already accepted as collateral at major trading venues. This is not a crypto product. It falls into the same category as conventional money market funds that hold cash, treasury bills, and repurchase agreements. The United Kingdom is also entering the ledger. In July 2026, the UK planned its first G7 digital sovereign bond, launching on HSBC's Orion platform within the Bank of England and Financial Conduct Authority's Digital Securities Sandbox to test reduced settlement times and costs. HSBC's Orion platform also earned the Digit Platform mandate in 2026, and the bank has already issued a gold token for retail investors in Hong Kong on its private Orion ledger, authorized by Hong Kong's Securities and Futures Commission. The scale of what is happening becomes clear when you look at the system as a whole rather than as individual press releases. The BIS has explicitly described tokenization as the next big thing, defining it as the digital representation of money and assets on a programmable platform, and arguing that this could fundamentally change how ownership is recorded and how transfers are executed across the financial system. Larry Fink's 2026 letter imagines a future in which a single regulated digital wallet can hold exchange-traded funds, digital euros, tokenized bonds, and fractional interests in traditionally illiquid assets. This isn't a fringe technology experiment, it's the largest asset manager in the world, describing its roadmap for the next decade of financial infrastructure. Part 4. The bridge problem. But here's where most coverage gets it backwards. Everyone in crypto sees JPM Coin and HSBC Orion and Euroclear DFMI and assumes the banks are building walled gardens to kill public ledgers. They see private blockchains and think competition. But the real story isn't about which bank wins. It's about what happens when every major bank builds its own ledger. More private ledgers doesn't mean less need for public settlement. It means more fragmentation. And fragmentation needs bridges. Comparing a private deposit token to a neutral settlement layer is like comparing a corporate intranet to the internet. They solve different problems at different scales, and the confusion between them leads people to exactly the wrong conclusion. JPM Coin isn't a stablecoin. It isn't a central bank digital currency. It's a tokenized claim on deposits for JPMorgan clients, useful inside one bank's ecosystem, but not designed to connect to every other bank's ledger automatically. BIS's unified ledger concept is explicitly framed in wholesale terms. The initial implementations are expected to be application-specific, bringing together central bank money and tokenized deposits, and serving as infrastructure for financial intermediaries rather than as consumer-facing products. Citi's 2023 Future of Digital Money and Tokenization report reinforces this shift by arguing that the contest is no longer between physical and digital money, but among different formats of digital money, including liabilities versus non-liabilities, regulated versus non-regulated, and token formats versus account-based systems. The real question is what connects these walled gardens when a global asset manager holds tokenized treasury fund shares as a liquidity buffer and needs to post dollar margin for an Asian derivatives position that opens Sunday evening. In the legacy system, they'd need to request a fund redemption, wait for processing, wait for the banking system to open, and possibly miss the margin window. In the new system, tokenized treasury fund shares can move as collateral across rails that never close, because the infrastructure is being built for settlement that operates around the clock across multiple jurisdictions. This is the shift that actually matters. It isn't about one bank building a faster internal database. It's about whether the entire network of banks, custodians, clearinghouses, and asset managers can settle with each other in real time, without passing through the legacy messaging layers that originated half a century ago. How the parts connect. So let's step back and look at the whole system as one architecture. The pieces are not separate announcements. They are one system, tokenized collateral from HQLA with an X and JPMorgan's tokenized collateral network. Tokenized cash from JPM Coin and stablecoin reserves. Regulated securities on ledger from DTCC and Euroclear, and legal frameworks that accept them from the ECB and the Bank of England and the FCA's Digital Securities Sandbox. The 2026 shift is not about whether this technology works. The technology has been proven in pilots for years. The 2026 shift is about whether enough institutions will migrate enough volume onto these rails to justify the infrastructure investment that has already been made. The protocol is built, the capital is positioned, and the regulatory framework in multiple jurisdictions is supportive. Legal clarity isn't the finish line. It's the on-ramp. The structural implication is that the quietest migrations are usually the ones that blindside entire markets. The migration is quiet because it's wholesale, and retail users never see the pipes, even though they still depend on them. It doesn't announce itself with price spikes. It announces itself with SEC relief letters, sandbox authorizations, and production launch dates. When you step back, the pattern is unmistakable. Every major market infrastructure operator is building on distributed ledger technology simultaneously, and every major regulator is clearing the path for them to do so at scale. What to watch and why it matters, that's the system. And here's what you should actually watch. First, watch settlement volume, not price. When tokenized repo, collateral, and securities settlement moves from pilot to reported volume, the economics of the system shift. Second, watch regulatory sandboxes becoming production. The UK digital sovereign bond, the ECB collateral eligibility, and the DTCC October launch are thresholds, not experiments. Third, watch bridge assets, not which private ledger wins, but which neutral settlement layers connect the most volume across the most walled gardens. If this kind of structural analysis is useful to you, subscribe. This channel is built for exactly this type of research. Tell me which milestone you think is most underestimated in the comments below.